So hi, today is March the 10th, 2022. My name is Scott Forehand. I'm an agency director here at Symmetry Financial Group, part of Quility. And we're here today to talk about the DebtFree Life program, which is a proprietary program that's offered through Symmetry Financial Group and Quility. So let's talk about DebtFree Life. What is it? So DebtFree Life, first off, what it isn't. DebtFree Life is not a debt negotiation program. Debt-free life is not a debt consolidation program. We're not going to pick up the phone and call your creditor and say, hey, I know we owe you $3,000. Can I give you $2,000 and let's call it even? That's not what we do. Another thing we don't do is destroy your credit. And the end result typically of all debt-free life programs, if you execute them correctly, is you should have a credit score above 800 within a couple of years. But the nice thing about having a debt-free life that's mature, it doesn't matter what your credit report is because you're never going to use credit again. You're going to be banking on yourself using your own money over and over and over again. So let's go forward. So debt-free life, the primary determinations of whether you need a debt-free life or whether you could use a debt-free life or whether you qualify for a debt-free life program are really an answer to one of these two questions. Are you 100% sure you're going to have a great retirement? Nobody can say that, especially once we get into this IRA discussion we're going to have in just a few minutes. And if we could show you a way to get out of debt in 9 years or less, would you be interested? I don't know anybody who has debt that if we could show you a way to get out of debt faster isn't going to answer that question, yes. But more importantly, and as you talk to some of the people that are experienced with putting these debt-free life programs in place, you'll find that it's really not 9 years or less. That's not the piece, the important part. The important part is how much sooner can we get you out of debt? Because in the end, if we can get you out of debt 15 years earlier than where you're on track for, that means that's 15 additional years you're going to have to create a massive retirement. And if you're using a debt-free life program, that retirement will be tax exempt. All right, let's move on. So most Americans, when we start, we're taught to debt is not a bad thing, and which is why it's so pervasive in this country, over $30 trillion. And with what's happening these days, we're going to hit that untenable $33 trillion mark where the country can no longer support the debt, and the debt will grow faster and faster and faster, and something else crazy is going to have to happen. But because of that, because we're taught it's okay to take on debt, we end up with this kind of pie chart analysis of our income and cash flow. 74 cents of every dollar an average American makes is going to either pay the banks an interest rate or pay the federal government, state government, local government taxes. And that absolutely is not the way this country was supposed to be set up. That's a big reason why a lot of people came over here, as well as religious freedom. And in the process of setting this up this way, we are all put into a situation where only about 25% of our income is used for us, for our lifestyle, for paying our bills and doing all those things. And then at the end, whatever's left over, we try to save, and that's about 3%. The average American saves about 3% of their income. And I don't know anybody out there who can survive on 3% of their current income, but if you can, great job. And if you're like the rest of us, probably not. So going to this next part, and here's an illustration of what I was just talking about. The average American makes about $2 million in their lifetime. That's a lot of money if you spend it correctly, right? So the average American using that 3% mark that we just talked about also only saves about $60,000 a year for retirement, or $60,000 for retirement. And if you're accustomed to making in your later years, which is your highest earning years of your life, if you're accustomed to making 100, 110, 120, and now all of a sudden you have to make it on 15,000 a year, it's not going to last long. Or if it does, it's not going to be fun. And you're going to be stuck relying on the federal government. Anybody trust the federal government right now? They're going to be stuck relying on the federal government for your income. Or you're going to be stuck relying on your state government's, if you're a state employee, your state government's retirement program. And there are probably at least half the states out there that at this point, you shouldn't have a whole lot of confidence in their retirement programs. So, and as we talked about just a minute ago, this is not the American dream. So what do? Well, the first thing we have to figure out what everybody else is going to tell us and tell us why they're wrong. So when you go to a debt consolidator, a debt negotiator, a credit counselor, they're going to list these bullet points of things you can do. And unfortunately, most of the public is going to buy it. and they're going to buy that, okay, I can work harder, but how long can you do that for? I can spend less money. How long can you do that for? I can save more. Well, that goes along with spending less. And then I can refinance. Why would you refinance? All you're doing is taking debt and giving it to another debt. And then I can consolidate. All that is making a lot of smaller debts into one giant debt that's even more difficult to pay off. All these things fail. They all fail for various reasons at various times, with the exception of that one down there, the debt snowball. And the debt snowball does work if you execute properly, but most of the time, people that think of a debt snowball, what they're actually thinking of is a debt stack, and debt stacks are inefficient. A true debt snowball is the most efficient way to eliminate debt, in conjunction with the other thing we're going to talk about today, which is an infinite banking. All right, so going on. So this is our better way. This is our debt-free life way. 9 years or less. Really 15 to 23 years early is what I would say is more accurate. Actually, 15 to 27 years. That's what I've seen so far. So what we want to do is we want to make a fundamental change in the way you spend money. We don't want you to go out and get another job. We don't want you to start eating tuna fish and ramen. We don't want you to start to have to raid your child's piggy bank. That's not what this is about. What we're talking about doing is spending money more efficiently. So if you think about this, if I take some money and I pay a debt, what's my gain? What have I done? I've transferred my cash to somebody else's pocket. And the only benefit I get out of that is I've reduced my debt. I haven't gained any money. We're going to show you how you gain money. We're going to show you how you spend less on taxes, significantly less, 25% over the course of your life. We're going to show you how you spend less on interest, 43% less on interest. We're going to show you how you increase the amount of money you're going to save for retirement, 500%, right? 500%. And then finally, we know that these programs will not work if for the user of the program, it becomes an uncomfortable cash flow process. So that's why what we do here is ultimately what it's going to do is it's going to increase the amount of money you have for your lifestyle without you making any more money than you're making right now. So how do we do that? We're going to reduce the interest you pay to lenders. We'll show you about how that works. We're going to eliminate all your debt 9 years less, 15 to 27 years early. We're going to reduce the amount of taxes. This is a critical part. If I'm not spending money on taxes and interest, then what can I do with that money? I can put it in my pocket, or I can put it in my rain check pocket and create a tax-free retirement income stream for myself. We're going to improve your cash flow. That means your spendable money as well as the money you're going to be saving for retirement. And then ultimately what we're talking about here is retiring with a tax favored income. In my book, there is no income, retirement income that's more tax favored than a tax exempt income. So there are programs that have come out before us, and a lot of them use different kinds of programs. There's ones out there that use home equity line of credits. There's ones that are out there that use universal life programs. And all of them have some benefit, but they all have an Achilles heel. Every single one of those other programs has a failure point. And they're all different, and they're different individually, but they all have a failure point. And so what we did when we developed this program is we created a solution that takes care of the number one reason why they fail. And the number one reason why all those other programs fail is because they don't plan for the unexpected. They expect for you to be able to work for the rest of your life, not anticipating that you might die early, get sick, not anticipating that you might lose your job, not anticipating that there might be a pandemic, not anticipating there might be a war. All these things they don't take into consideration. This program does. And we take that into consideration by doing this. We created an emergency fund where about 20% of the value of your program is hidden. It is there. You can get to it. You should only be using it in the case of emergency. And when I mean emergency, I mean emergency. I mean, you don't need to go out and buy a new jet ski. I mean, you've got something crazy happened. Your brother just got diagnosed with XYZ, doesn't have any money. They're getting ready to lose their house. You need to rescue your brother, whatever. There's all kinds of reasons that are real emergencies, but that's what I'm talking about. And if you have a real emergency, then use it. That's what it's there for. And that's why these programs continue to succeed and don't fail. When we compare these programs, this is a great slide leading into this afternoon, or the rest of today. This is when we compare these programs as they perform against an IRA, against a traditional put money under the mattress, put money in a savings account, or versus what we're doing here at DFL. Those are those three columns. And if we use that same investment metric, $10,000 with the same tax rate, 7% interest rate, 28 years as an investment time frame, then this is what a standard $10,000 investment is going to grow to. Is it something that will always work this way? Well, in the case of the DFL, that tax-free retirement column, absolutely. The numbers are guaranteed. And we're not taking into consideration the fact that you might get a dividend, or actually in one of the cases of our programs, you will get a dividend. Okay. So that middle option there, that tax deferred option, this is what Laureen was talking about just a minute ago, putting money in a 401, putting money in an IRA, TSP, KEO, FIRST, SEP, whatever, it doesn't matter. All of them are deferred interest programs. And you are growing the value of your program at the same rate that you are growing your tax exposure, which is why those programs are inferior to a DFL program. Let's move on. So this is a financial instrument. It is a financial instrument in the form of a life insurance policy. And all financial instruments work the same way. They work in phases. And this is a standard phase structure for a financial program: maximization, accumulation, distribution. Maximization phase. This is where we are putting money into the program to the point where our growth is maximized. We want to get it to the point where we're putting more money into this program, period, that whatever that ceiling is, wherever that top number is, we want to get there as quickly as possible. That's maximization. Once we reach that level, that plateau level, then we're in the accumulation phase. In the case of what we're talking about today, that means we've eliminated the debt. We've eliminated all those inefficient expenses, like putting money into a 401k or putting money into a certificate of deposit. Those are really, really inefficient growth models. Okay, so we're putting out as much money as we can into during the maximization phase, and then we get to that accumulation phase where the amount of contribution is leveled off, and we're just getting to that point where it's okay to go out and buy that emergency jet ski, or take that emergency trip to Tahiti, or take that emergency class about how to speak with clicks. That's the distribution phase. Right on. Moving on. This program, as I mentioned, has been around for a long time. 1904, the first one of these programs was written, and it's written to somebody whose name you might know. Their last name is Rockefeller. These programs used to start previously with large sums of money coming in from the insured. And typically, to start these programs back in the past, you need to have about $1 million, about 7 figures of cash to deposit into the program, because we're going to learn a little bit later, these programs earn what's called positive arbitrage. And the reason why they're able to do that is because you're giving something, the carrier, a large sum of money to invest over time. And so they're willing to pay you a large interest rate because of that. These are some of the people that have done it before. Walt Disney used this to fund Walt Disney World. Ray Kroc used this to fund the first 12 McDonald's units. Warren Buffett uses it to this day. It is actually part of the Buffett method when you talk about trading. The Pampered Chef, Doris Christopher, she used it to start Pampered Chef. The Rothschilds use this. Kennedy's used this. All the big financial names that you can think of in history from 1904 on, all those people, all those families, all those very, very wealthy groups used this as a vehicle, not only to store and grow wealth, but also to transfer wealth generationally. All right, let's keep going. So how are we going to do this? This all starts with efficiency. If I'm earning 1.1%, which is unheard of in a savings account, why in the world wouldn't I want to put it here where I'm earning a minimum of 3%? We're going to grow the cash value. Whereas if I have the money using a savings account again, if I have the money in a savings account and pull it out and use it, what have I done? I've decreased the amount of money that it's exposed to interest. In this scenario, I'm never pulling out my money. And that's another key tenet about how this program works. I'm going to pay off my debt 9 years left. We keep coming back to that. No, it's 15 to 27 years early. So you're going to hear this word said, I'm going to be taking loans. I'm taking loans against the value of the policy. Do I have to pay that loan back? Maybe. Do you want to pay the loan back? So let's think about that for just a second. So in the process of taking a loan, what are you really doing? I'm borrowing money from myself. So if I want to pay my loan back to myself, I'll pay it back. If I don't, I don't. Am I going to come after myself to not pay my loan? Am I going to sue myself? No, it's my money. I'm doing whatever I want to do with it, right? So that's the idea. We have control. We're taking control away from the banks, and I'll show you this in just a second, taking control away from the banks and putting control back with the individuals. We're taking control of our financial future, and we are steering the boat. And we are letting who we want on the boat and kicking those that we don't want off the boat. Student loan people. All right. So at the end, don't forget, this is still, we're using a life insurance program to create this private bank. So one of the really, really cool things about this is you can't defeat it. There's going to be a death benefit associated with this that's going to survive you. It's going to create a legacy for your family. And if you're doing some of these programs that we talk about, where we find all the money that you're spending inefficiently and we repurpose all of it, your death benefit is going to be massive. And your family and your family's children and their grandchildren are going to be fine for generations. So this is a very old slide from when Symmetry first started doing these programs. Those are some of the first families, or at least they might be actors representing families, I'm guessing, maybe, I don't know, of the people that we were first helping. This is, again, we keep seeing the consistent thing. We're going to improve cash flow. We're going to tax favored income. We're going to reduce taxes, reduce interest, the whole 9 yards. It's still the same thing. It's worked that way since we started this, and it still works to this day. I just had a meeting the other day with a client we're going to talk about today. They're ecstatic about what's happening with them, and this is really cool. So let's talk about, this is the key thing here. We want to get to where we're spending money efficiently. So before you can figure out how you spend money efficiently, you have to figure out why you're spending money inefficiently. And that's because of this. This is how you currently spend money and make money. You take your money, whether you're a 1099, W-2, W-4, mailbox money, under the table money, whatever, you still make your money. You deposit your money into your checking account with whatever bank you bank with. Wells Fargo, Bank of America, Citibank, SunTrust, Truist, whatever, doesn't matter. And then your money is now deposited in the bank. And if you're going to the Bank of Betsy and they say, thank you very much for putting your money with our bank, and I'm going to allow you to keep your money in our bank, and I'm not going to ding, 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 charge you to keep your money in our bank because you're keeping a high dollar value, what are they really doing for you? They're not doing anything, right? What are they doing? They're making money with your money every night. They're lending your money out at the federal funds rate. The average dollar that you put into your bank gets lent out 7 times before you actually ever use it. And then finally something happens and it comes time to pay that bill, pay your car payment, pay your credit card payment, go food shopping, whatever. And you say, hey, Mr. Bank, Betsy Bank, pay my debt for me. And you tell them through bill pay, or you write a check or whatever to transfer money from your bank that's their bank and move it to your whoever you owe money to. What have you done? You have put money into a private bank or a public bank, Wells Fargo, Citibank. They used your money over and over and over again. They didn't give you anything to be using your money. And then they sent your money off to your creditor. What's your gain, DJ Debt Free? How much money did you make in this process? 0. You transferred your cash for a reduced amount of debt equal to a reduced amount of debt. You actually have 0 gain. This is inefficient. And in the meantime, your money was being used by somebody else and they were making money with your money. So let's change the game. Here's the game. Here's the new game. Same process. You make money, gets deposited as income into your checking account. And this is where we change. What we do is we send money to our whole life insurance policy. It's a very specialized kind of whole life. It's called a participating whole life. What is that? That word participating is critical here. Why? Because it means that you get to participate with the profit of the insurance company based on how much money you're putting into the system. Okay. That whole life policy has 2 very important riders. Has a term life rider and it has a paid up addition rider. Let's explain these things. Term life rider, all that is, it's a large death benefit policy for low cost. It's a rider. It's not a core policy. It's just a rider. The core policy is the whole life. And then finally, paid up additions. That is paid up life insurance. And just to put things in perspective for what that means, if you have $1,000 of paid up life insurance, what is it worth tomorrow? $1,000. What's it worth 10 years from now? $1,000. What's it worth 20 years from now? $1,000. It never loses value. And how much do you have to pay for it to maintain its value? Zero. So it is a near permanent asset that never depreciates, never loses value, and you don't have to spend anything to maintain its value. In the grand scheme of things, banks rate assets in tiers: tier 1, tier 2, tier 3, tier 4. And with each tier, as you go down a level in the tiers, it becomes a higher risk to the carrier or to the bank, but it also becomes potentially more profitable. So a tier 1 investment might be a pound of gold. A tier 4 investment might be lending $1 million to a 22-year-old busboy so he can open his own restaurant. What are the chances that's going to pay off? Not going to happen. All right. So in the grand scheme of things, paid up additions are considered a tier 1 investment by banks. And as an example of that, Wells Fargo is the largest holder of life insurance policies as an investment in the United States. They hold 48% of their tier 1 investments are life insurance policies. So when you hear those radio advertisements, hey, if you've got a life insurance policy worth $100,000 or more, don't cancel it, call us, we'll buy it from you. That's what that's about. They're going to give you 10 cents, maybe 5 cents on the dollar, pay the premiums for you until you pass it and move on and get paid a mint when that happens. Okay. So we've got the whole life policy. We've got that term life rider. We've got the paid up additions. Why do we have the term life rider? This is an IRS issue. So there's a thing called a modified endowment contract, which says if the cash value of a life insurance policy exceeds the life insurance value of the policy is then considered an endowment contract. An endowment contract, it's not considered life insurance anymore. And the minute that game changes, where it becomes a life insurance contract, it is no longer tax exempt. It's no longer tax free. It's no longer tax deferred. Everything you derive from it at that point forward is taxed. Okay. So that term life rider is here specifically to create this umbrella so that the IRS can't see beyond that the cash value is larger than the death benefit, because it's not. Because with that term rider, we're keeping this massive amount of death benefit here. Now that paid up additions, this is a key thing. Paid up additions is life insurance. As you grow the paid up additions, you're growing the life insurance. And eventually you get enough paid up additions where you don't need the term rider anymore. And it goes away because the paid up additions counts as death benefit. One of the other key things here, and this is why this is called an infinite bank. The other thing here is because you have all this cash that's being stored in this program as a paid up addition life insurance, the carrier says, well, thank you for giving us this money to invest. We're going to allow you to participating whole life. Remember, we're going to allow you to participate with the profitability of our company based on the cash that you have in your program. And a couple other factors like how long it's been there, what your expected longevity is going to be, and a couple other pieces. So the idea here is I've got this one bill, let's say it's $100. I send it out of my bank and I send it up to my life insurance company. My life insurance company says, thank you very much. And they split it up. We're going to use X number of dollars to pay for your term rider. We're going to use X number of dollars to pay for your whole life. And we're going to use the rest of it to buy additional life insurance. That's why with these programs, every single payment you make, there's an immediate recognition of cash value and an immediate growth of cash value. That's a key difference between this program and universal life programs. Okay. So now, what did I do? I took my money out of my checking account and I paid my life insurance premium. That's all I did. But because of the way my life insurance premium is structured and is set up, I'm getting a recognition as cash from the carrier of about 78%. So if I use a standard distribution model, 68% going to paid up additions, 11% going to term, 21% going to whole life. And then that whole life 21%, that's further split up where 10% is going into cash value and 11% is going into premium. That means I'm getting a recognition of about 78, 79, maybe 80% of every single payment as cash. Okay. So I'm getting a large death benefit. I'm getting some basic living benefits. I'm getting cash. I'm getting a guaranteed interest rate. I'm getting a dividend. I'm getting the opportunity to use my money when I want, where I want, without having to qualify for it, without having to ask permission. Or I can put it in an IRA and go through what Laureen's going through right now. So what did I do? I created a bank. I'm using my life insurance policy as a private bank. All right. So now, how does this system work? So let's say I've been putting my money into Betsy's bank and we're having good luck, but I wanted to buy my whole life piece. I want to get that started. So I started it, and now I've got to pay DJ debt free because he gave me money to buy a car. All right. So now I got to pay DJ debt free back. So is it better for me to use my money or to use the bank's money, which is my carrier in this case, to pay DJ debt free? And in this scenario, and in every other scenario, I will always tell you, whenever you get an opportunity to pay a debt with somebody else's money, that's the best way to go. So in this case, I'm going to take a loan. I'm going to take a carrier loan from my private bank. It's not that I'm taking my money out of my private bank. I'm never touching my money. I'm never touching the principal. I am taking a loan using my principal as collateral. In my loan, I'm going to take my loan with a net cost. In the case of one of the carrier we have tonight, that's our special guest, the net cost is going to be 0.85%. Does anybody know anybody where you can go borrow money at a net cost of 0.85%? You know, no. What happens if you dump $200,000 in a year and then you want to go out and buy a home and you want to go get a new home loan? You got to go through that process, credit check, background check, qualify for it, pay 3%, pay 2 points up front, all that stuff. Or I could just borrow it from myself at a net 0.85%. Which one's better, right? So I'm going to borrow the loan from my carrier. I'm going to keep my money in there. And then that money is going to get deposited back into my bank of Betsy. And I'm going to tell Betsy to pay my debt. And Betsy's going to send the money to my creditor, and they're going to receive the money. So let me ask you this. Do you think anybody who's receiving money as payment of debt cares where the money comes from? Do they care that the money was from you or from a loan? They don't care as long as their loan gets paid down. That's all they care about, right? So in this case, it doesn't matter. So if I look at this and the way this works, this is a debt-free life method for spending money. Let me ask a quick question. Where's my money? My money is still in my debt-free life bank. I've paid my debt. They're happy. I'm still paying my premium payments. My carrier's happy. I'm taking the money out of my bank of Betsy. Betsy's not happy, but I don't care really about the bank. And I'm growing this nest egg. And every time I make a payment, I'm getting more and more and more. So where's my money? It's in my bank. Now let me ask you this. What's my gain? 100%. In the previous example, I traded my cash for elimination of debt. 1-to-1, no gain. In this case, I traded somebody else's cash for elimination of debt. The elimination of debt. Debt's gone. That's a gain. I still got my money. That's a gain. My gain is 100%. And that's a hard thing for a lot of people to get their head wrapped around with these programs. Okay. So every time you do this, it's a 100% gain. All right. So here's that example. This is a family. I met with them last week. We did our 3-year follow-up. So let me get back. So this is where they were, 36 years old, 3 years ago at this point, back in 2019. They were on their track to pay off all of their debt in 40 years because they had a large amount of student loans, because as we say all the time, student loans are evil.
You're not advancing.
Say again?
It just says family example.
Oh yeah? Maybe I should show you what I'm looking at then, huh?
Well, it might be easier to understand.
Everybody can thank Lorraine Breitkreutz. Thanks, Lorraine. Appreciate it. So here's where we are. Here's where they were, 40 years. This was their true debt. If they had the opportunity to pay off all their debt at one time, they would have had to have written a check for $585,000. Instead, since they don't have the ability to write a check for $585,000, the banks are thankfully going to take $767,000 from them over time. Okay. Bad deal, right? It's a bad deal. $182,000 of scheduled interest, bad deal. This is where they were when we were done with them, 7.8 years. So we saved them 32.2 years of payments against a debt. And that, when you look at how much money you can save over time, which we're going to illustrate in just a second, what that means is we're really, really able to hypersize their retirement. So this is the meeting we just had. They're getting ready to pay their last loan off, their car loan, which was a 7-year loan when we started. They're getting ready to pay that off in 2 months, but they've paid off everything up to that point. Let's have an aha moment here. Here's your aha moment. 40 years with $182,000 of scheduled interest, and zero. And look, what's at the end of that 40 years, what were they going to have? They were going to have 100% interest in 2 properties. That's it. That's their retirement. Okay. And this scenario, we eliminated 32.2 years of interest and tax payments, saved them $70,000, which goes right into their pocket, and created $4.8 billion of liquid cash in their program. That's through the effect of compounded interest and a dividend. All right. This is not magic. It is just math. I say that all the time, but it's really true. There's no special sauce here. This is just math. Einstein said it. There's nothing more powerful than the effect of compounded interest. So when I look at their program, this is it. Each one of these yellow bars represents a year in which they paid off at least one of the debts. This is where we are right now. They've got 3 years left. They'll be finished with this year. This is October. This represents October. But in October, this is where they'll be. They're almost there now. Got a little bit left in their car. Then we'll pull the trigger and pull out like $50,000 and pay off their last car. If they didn't do any of the extra things that we can do with these programs, this is where they would be. But what they're getting ready to do is next year, at the end of the year, in year 4, they're going to pull out $90,000 and mortgage chunk their first mortgage. And that mortgage is not going to take, it's going to cut about 5 months off their program by doing it that way. And by mortgage chunking, it's going to be a 16% more effective program. So 7.8 years is not where they're going to be. It's going to be more like 7.4 years, which is freaking awesome. All right. So this gentleman told me he wanted to retire when he was 75, because that's when he thought he was going to be how long he was going to have to work to the point where he had enough retirement income and 401k money and all that stuff. We got him retired at age 55 with $1.5 million in the bank, earning $111,000 of interest that he can take as a tax-free retirement income stream. You should all have had a holy cow moment just then. So that's kind of the end. I have another illustration that I usually show about someone who doesn't have a mortgage, just a regular student, which is fine. If you guys want to see it, I'll show it to you, but it's nothing special. It's just she had $90,000 in student debt. We got it eliminated in 9 years. And by the time she's 65, there'll be $400,000 in the program, doing it on a waitress's salary. Nothing wrong with waitresses. I used to own 7 restaurants. Nothing wrong with it. Okay. So the idea here is that it's not about how much money you make. It's not about how much money you stuff into a 401 or any other retirement program. It's about how much money can you retire with that's tax exempt, that the government can't touch, the IRS can't tax, the federal judge can't order you to drain. These are tort-proof events. These are tort-proof programs. So thank you for listening. Right on, DJ DebtFree. So I'd like to introduce a special guest today. We have with us Mark Creighton. Mark Creighton is the Vice President and and guru for mutual trust, part of Pan American Life Insurance Group, PALIG, one of, I think they're the largest or second largest life insurance company in the world. And thank you, Mark, for joining us. And the programs that I use today, by the way, guys, those illustrations that I used, those illustrations were done using mutual trust programs. And Mutual Trust is the company I was talking about that was the originator of these programs back in 1904. So hi, Mark, welcome.
Hey, good evening. How are you doing? And good evening, everybody. Excellent presentation. I love it.
Right. So
I thought you were going to steal my first line.
No.
You started down the road, but you didn't finish. I'm like, what am I going to start with? Robert Kiyosaki, author of Rich Dad, Poor Dad. He said, it's not how much money you make, it's how much money you keep and how hard it works for you. And this is exactly what this program cuts at. It is the ability to utilize dollars and make them do different things. As representative of Mutual Trust, I can tell you this is a program we absolutely love. You'd think companies would look at this and say, wait a minute, your clients are going to give you money and then want to use it right away? Please do. Key thing that you pointed out, we're a mutual company. You get to share in our profits, and something that separates us from a lot of other companies out there. It's the sole purpose of our existence. It's for the benefit of our clients. We're not here to make wealth for shareholders. We don't worry about quarterly reports or what that looks like. We're worried about doing the right thing for the clients, and we're simply custodians for the client's money. It's there for them to use. We've maintained a position where as soon as they have a policy, if they can start using it, please do. We love it. We love to see how important life insurance is, not only for the death benefit, because that's what it was there for initially, but as you said, this concept isn't brand new. The idea of using your money has gone a long way. There's an example you didn't give that I think is really cool, especially in light of where we may be heading and what we're seeing with gas prices.
Yeah.
JC Penney is another guy. I don't know if you have JC Penney's around you. You know, the big box stores, they're all kind of going away. We've got a JC Penney here in the mall, just a couple miles away from me. They're still thriving. In fact, I think their business is as good as it ever was. In the Depression, the Great Depression, we're getting to a point now where there might be many in this country. But the original Great Depression, JC Penney used his cash value and his policy to keep payroll going. And look at what that's meant for him. So if you're a small business owner or own a small business owner, you get in a hard time like we've seen over the last few years, what would it mean to them if they had that capital that they could use? Sure, they can go to a bank, but banks are great. As long as you prove you don't need the money, you can get the money. Mutual Trust, we don't ask you why you want to use it. Just a simple request. Tell us how much you want. You control the rest.
Right on. Love it. Yeah. You know, that the JC Penney thing, that's great stuff. I'm gonna start using that from now on. But one of the things you just said is what we're talking about today, because I used what the history of the market shows us and how there's one of these downturns regularly. But when you look at the speed of the downturn of this one and the fact that it's not going away anytime soon, we have a constellation of factors that are going to significantly impact everybody in this country. We're not looking at a 33% loss of the market like we had in 2008. We're looking at a 40, 42, 44% loss. And when we look at the maximum rate of return of when we can get back to zero, it's not going to be like it was in 2008. We're back in 2012, 2013. You were there. It's going to be longer than that. It's going to be bad. And so that's why when we get to talk about what I'm talking about in just a second, these programs are invaluable. And you know what you said, Mark, is great. Penny used it to fund the ability for him to make payroll. Okay. Well, if you think about this as your own payroll company, what happens if your job goes away? You know, you can be your own unemployment insurance, and you don't have to go prove that you made 20 applications and ask for your $400 check and wait for it in the mail. You don't have to do any of that. It's just there. So that's something I've been doing with these, especially for people that are government contract workers that are 9 months on contract and 2 months off. We're setting them up for those folks. so they can build it over the 9 months, build up cash value, and then live on that cash for 2 months, then do it again, and then do it again. We used to only have one choice to do that, which was an IUL with a balance sheet benefit rider. But now we've got two, and this is superior to that. So thank you, Mark. Thank you for your company and for what you guys do. If you hadn't had an opportunity to work with Mutual Trust, their customer service is top notch. Folks are easy to get a hold of. You call the phone, you get a live human being who speaks English from this country. It's all those things that everybody talks about. So thanks again for coming, Mark. I appreciate it. Any last words?
Oh, what I was going to say, yeah, I do have one. And thank you very much for having me. It's always a pleasure. If you're a client or you're working with clients who have some young kids, they're taking things into their own hands already. Guess what else whole life is? Permanent insurance is. It's not disclosable on a FAFSA. So you think about college education and how expensive that is. That's an asset they don't ever know about. So they're building their own wealth. They're getting out of debt. And by the way, they may be eligible for more financial aid.
Hey, Mark, let me read between the lines here. Are you saying that if I've got a client who's got a child, they're getting ready to go to college and they want to get a grant, Pell Grant, or any other type of financial aid, and I've got $100,000 sitting in my savings account, which is going to keep me from getting approved, I could put that $100,000 into a mutual trust, participating whole life account, and then I don't have to report it? Is that what you're saying?
That's what I'm saying.
Okay, just want to make sure everybody got that. Thank you.
You got it.
All right. Thanks, Mark. So,
Hey, Scott,
yeah.
DJ Tax Free concurs over here. For everybody who doesn't know, this is Tatiana Selivanova, an IRS enrolled agent. So she has the right and the license to be able to give tax advice and confirm what Mark just shared.
Right on. Thanks, Tatiana. All right. So right now, before we move into this last segment, if there's anybody who has any questions, pipe up. If nobody has any questions, then let's get to the fun part.
I have a quick question, but it may need to be deferred. But since you're in Virginia, you have a lot of, I'm assuming a lot of clients who work for the government.
I
so
do.
Therefore, they're putting money into a TSP plan.
They are.
Is there a maximum? Is there a maximum amount that's matched that they don't have to go beyond that point?
There is a maximum amount of match on a TSP. It is actually different, to my knowledge. It's different based on their geography and their job. So I don't have a hard set number that I look at. But what I've seen is 3% to 6% match, that range on TSPs.
I have a client that told me today that he's putting in 15%. I said, whoa.
Yeah. So, yeah, I don't know what the ceiling is, but we'll show you. I mean, this is the one that I'm doing today. This is based on a TSP.
Okay.
All right. Anybody else? Tommy D.
So what did you say about me when I was on the phone?
Oh, you'll have to wait till this gets posted and go back and watch it yourself.
Okay, so just for the record, it is a classic sweater, and I do love it. And I've lost a little bit of weight, so I need to wash it so it shrinks. That's definitely something I need to do since I had this. And Mark, thanks for being here, man. Really appreciate you.
Absolutely, my pleasure.
All right. Let's get going here. So let me get this set up for you guys. Okay. Okay. So this is what we were just talking about. So this isn't, can you guys see my screen okay? Yep. Okay. So when I go back and I look at the history of the stock market, there's a couple of interesting things there. Casey talks about them as inflection points. And there are a couple, you see this, and it's actually cyclical. You see it every 8 to 20 years. You're going to see a market correction. Sometimes the market correction is called depression. What we're getting ready to go into is going to make the depression look like nothing. It's going to blow the depression away. What's getting ready to happen, I think. So in 2008, we had a major hit. 33.4% of the market was lost. It took 4.6 years for the market to come back. And that's important because I'm talking about how an IRA performs versus a DFL program. And I'll show you that in a second, but I want you to keep that in the back of your head. It took 4.6 years for the last one to come back to even, okay? This year so far, we've lost 8.4% since January 1st. If this stays on that track, we are going to lose 42%. It will be the largest amount of money the stock market has lost in the history of the stock market. It will be the worst it's ever done. And we have two other things that are happening here. Because of the nature of how this Russia-Ukraine thing is going, we've got the highest gas prices in the history of the United States, which affects everything. And we've got the highest inflation since 1982. Anybody remember what happened in 1982? Yeah, so there's all kinds of crazy stuff that happens. A lot of it has to do with the strength of our country or the international perception of the strength of our country. A lot of it happens to do with gas prices, okay, which ultimately trickles down to affect everything. If this rate of market loss continues and we have the highest highest amount of loss that I think we're going to have, then if we apply what the fastest recovery has been, it's going to take 5.78 years to get back to even. Okay, 5.78. So when we talk about loss, especially when we talk about market loss, a 10% loss isn't really a 10% loss. It's much more significant than that because you have to come up at least 11% just to break even. But then if that's a 2-year run, what did you really lose? You didn't lose just 9% and come back up at 10 or 11 to make up the difference. You also lost that potential gain over time. And this is where the lie of the IRA really shines through. IRAs don't have gains every year. They have regular losses. The average loss happens every 4 to 6 years. And sometimes it's multiple year losses in a row. So when we're trying to time this stuff, nobody can time it. Nobody has that skill. The best stock people in the country are about 55% accurate. And they make a ton of money being 55% wrong and 55% right and 45% wrong. A ton of money. So if you think, more power to you, God help you. If you think that you have the wits about you to time the market correctly, great. I wish you the best. The chances are you don't, okay? So this market volatility that is purported to be such a beneficial thing within investing strategies is a huge detrimental problem. It is not a benefit. It's a horrible thing, volatility. And if you're trying where we are when we get to be 45, 50, 55 years old, when you're trying to figure out how much money you're going to have for retirement and you're using this as a tool, then you're going to run into some of the problems. Like every time I take $30,000, I have to take out 40 because I owe the taxes on it. And that's going to significantly impact the growth or the continued growth or the stability of your IRA over time because you don't have as much money in there. Okay, so how do you fix it? Well, first thing is let's take a look at an IRA versus a DFL. So if I use a standard $10,000 investment like was done in the original presentation, and I use a 28% tax rate like was done in the original presentation, and I start with a $10,000 investment, and I start, let's say January 1st of this year, this is what my run is going to look like over the course of the next 10 years. I'm going to lose money, lose money, lose money, lose money, break even. Then I'm going to start gaining money, gaining money, gaining money, gaining money. And I'm going to get my $10,000 investment back up to $12,714. If I just started with a DFL, I'm going to be up to $14,000. So by default, before I look at anything, my DFL is going to perform 16.4% better, right? Is that really the case? Not really. Why? Because of taxes. Because I'm growing the taxes at the same rate that I'm growing the gains. My taxes at 28%. Wait, does anybody think that 10 years from now, when you take money out of these programs, you're going to only be at a 28% tax rate? Does anybody think that? I hope not. The only way the only way this country has to save itself from this debt monster that we're all dealing with is to raise taxes, right? So that tax number, 28%, realistically, I'm expecting 30 to 40, really, probably 38% is where I think it's going to be for me. So, maybe DJ tax free can confirm that if she needs, wake her up. All right. All right. So if I take out the taxes, what's my growth? My $12,000 is not $12,000. It's only $9,000. But my DFL program is still grown. And my DFL program at that point is 61.7% more effective than my IRA. I mean, here's one of the things we talked about in the past. If you have an IRA versus a DFL program, the IRA may in the short term outperform the DFL, but as soon as that IRA has a loss of a year, this DFL program is a juggernaut that it will not be able to catch up to, especially if we follow the trend of the market growth, expansion, contraction over years. We've had one time where we had 9 years of growth in a row, once in the last 110 years, once. Is it going to happen again? Maybe. Probably not. So let's move forward with this. So let's say, well, yeah, but Scott, we just had that growth. Okay, here are the real numbers, folks. This is exactly what would have happened if you had invested that money in 1991, invested that same $10,000 in 91 using the actual growth from the history from 1991 to 2000, which was the best 10-year run in the history of the country. And that's where you would have been 40,000. And your DFL value would have been 15,920. And then after you take out the taxes, you would have been at 28,000. So in this one singular instance, the market outperformed the DFL significantly, 44.88%, significantly, once in the history of the country. So for me, when I'm looking at, do I want to put my money in an IRA? Do I want to put my money in a DFL program? It is a no-brainer. I do not want to try to time this. I don't want to try to get lucky. I want to do what I know. I want to know that in 10 years, I'm going to have X. And if I'm using a program that uses guaranteed growth and I'm using appropriate and prudent money market management strategy within my DFL program, I know how much money I'm going to have. And that's an interest. It's a completely different thing. All the folks that you talk to and everybody that's concerned about their retirement program, that's because they're not in this. That's because they don't know where they're going to be and they have no idea whether they're going to have enough money. So let's take this one more step. So under the best market condition in the history of the stock market, the market will outperform the DFL for that 10-year run only by 44.88%. That means you have perfect timing. You haven't made any mistakes. You haven't missed any opportunity to capture the market. And then you're going to have here's the downside. You're going to have a market correction every 8 to 20 years. That's cyclical. You can look back in the history. You'll see 3% down, 2% down, flat, 3% up, 4% up, flat, 19% down. That's that market correction. And that happens about every 8 to 20 years. So if you're doing this with an IRA, that whatever you think you've gained, you're going to get maybe 20% of it erased every 8 to 20 years. And so when you have that effect, that impact, that really resounding impact on your nest egg, and then you have to come back up 22 plus 10% or whatever it is to get back to even, all the while your DFL is that little engine that didn't stop. It's still rolling, it's still chugging, and you're pulling money when you can, money when you need, paying it back maybe, all those things that you can do with the DFL. This is, again, only one time where it's going to outperform. So one more thing to look at. So let's look at, well, what if we're looking at the average growth of the market over time? So I took two separate averages. I took an average of 50 years from 1970 to 2020, and I took an average of the last 20 years, which because of the nature of the way trading has changed, with algorithms, with AI involved, we're actually more efficient in growth now than we were 30, 40, 50 years ago. So that's why when we look at these two data points, we had an average of 1.9% growth over 50 years, or an average of 3% growth over 20 years. Well, don't forget, that 20-year segment, that's right after the fastest growth in history. So if we look at an average of 2.5%, 4 or 5% of an average growth, then we are way below. And here's what I'm saying. Let's change this. So if I look at the average growth over the last 50 years using weighting a 20-year high growth and a 50-year average growth, then what I'm looking at, this DFL program will outperform by about 50%. If I need, and look, this is assuming I have an average growth, meaning I've got a gain every year, no losses, right? In order for me to have a IRA outperform a DFL, I need to have 7.6% growth every year, 10 years in a row. It has never happened. Let me let that sink in for a second. In order for an IRA to outperform a DFL, it has to do something that has never happened, that is way outside the profile of a 6.3% average growth over time, way outside that profile. So when I'm talking to people about this, I am very comfortable and very confident in saying, no, an IRA cannot outperform a DFL over time. So I'm going to shut up for a second. Let anybody ask you any questions that you have. Oh, by the way, this information is taken from macrotrends.net, and you can go and get it anytime you want. It's all right there. So
Sorry, I'll put my hand up. You
go
said
ahead,
question.
DJ.
Yeah, thank you. So the couple of variables there that I know, like I'll just play devil's advocate because you already know I agree with the philosophy, but the hypothesis here, where did you find that that 42% predictor that you feel like we're about to experience? That's number one.
Yeah, let me explain that real quick. We are on a track for a 42% loss. This is the real loss so far, 8.4%. That's what we've seen as a drop from January the 1st. And this is just me taking the number of days in a year on the trend that we're on. That if we stay on this trend, we're going to have a 42% loss in 2021 or 2022. Just like we had a 33% loss in 2008.
So there's the, if we stay on the trend.
Yep.
Okay. Because I could certainly pull up a graph that says March 24th, 2020, we dropped about 30% and recouped inside of 6 months.
Right. Yeah. I'm using annuals because an annual is it's a much larger population to do statistical sampling.
Sure. Because ultimately, right, I can argue variables in terms of like, okay, during that time we were in a different government control, right? There was a very aggressive government versus a very conservative government and all that stuff. And I'm Canadian, so I'm not interested in any of it. But ultimately, I also wanted to ask about the assumption of a 28% tax rate. So where you're showing those comparisons, you've got a 28% tax rate. And what if, my response to that is, well, my CPA says I can get down to a 22 inside of retirement, or at least a lower tax rate. What would be your response to that?
My response would be that may be the case currently, but with where we are and the growth of the government and the need to have more and more taxes placed on the population, that you might be able to do that this year, but you're certainly not going to be able to do that 10 years from now. And you're going to be, and I still think 38% is where the average person is going to be in about 10 years.
I mean, look, and I don't want to get too, thank you.
Oh,
for
wait,
that.
one more thing.
Yeah.
I have a friend of mine on Capitol Hill that saw a plan that said they were going to reduce the federal tax rate across the board at every income level, 1% per year, every year for 10 years. And that's kind of what was in the back of my head of where this is going.
They're going to increase it or reduce it?
They're going to increase the federal income tax rate 1% per year, every year at every income tax level to be able to make up the deficit.
I mean, look, I'm someone who watched the movie and read the book, The Power of Zero, to understand that, by 2026, 27, healthcare and Social Security are in jeopardy, but I'll leave that to everyone to go look at. So my final piece was, you highlighted the 10-year from 1991, right? That
Yeah.
was okay. In 1991, the United States went to war with Afghanistan,
Yep.
right?
And that's,
Overseas, and one could say right now, there's a similar geopolitical thing happening. And so why couldn't I expect the next 10 years to be similar? What would you say to that?
so I'm still saying, I'm looking at what the numbers are right now. I'm looking at 8.4% drop. I'm looking at people's IRAs losing 17%, 19% because of the way they're heavily invested and weighted. I'm looking at hedge fund guys starting to pull the hedges. And I hope I'm wrong. I'm not making a prediction. I'm just doing the math. This is what could happen based on the trend that we're on right now.
I mean, when a guy like Warren Buffett pulls almost everything and goes into like guaranteed segments, it says something.
Yep.
And I hope everyone understands my line of questioning is really based around two things. One, I'm waiting for these objections, right? When sort of this information is shared with folks who really hone in on IRAs. And two, like, I believe wholeheartedly in debt-free life and guarantees and less risk. And that's very much echoed by, say, bank-owned life insurance and folks in sort of the wealthy segment of the world who are doing the things you just talked about. But when you get with skeptical people, right, sometimes they're going to throw these things at us. And so, I'm just wondering if Mark had a comment on any of what I just brought up. Like,
Mark on the hot seat, huh?
what would the insurance carrier say to someone, right? Mark sitting with a client and representing mutual trust and going like, okay, I am biased, right? I work for mutual trust. I work for an insurance company. So tell me why I should believe some of these variables are going to happen, or what's your sense of why you're going to protect my money better than, say, out in the free market?
Why is I'm going to start with the why is your money protected, because I think that's a big deal. Insurance companies are heavily regulated, and we're kind of regulated by ratings. We want nice ratings. We want to be secure. So our investment types are very secure, fixed investments. We're not playing in the stock market. We've got a little bit of stock. I mean, like a couple percentages of our investments are held in stock. We do invest in some real estate, but it's very safe real estate. It's not speculative. It's a lot of corporate real estate. The most of our investments are held in bonds, fixed bonds. And you take a look at where we are, and to give you proof of this, think back at the end of 2020, the CARES Act passed, which contained a bill that required all insurance companies to revise their interest rates they use to credit their products. Why did we have to do that? Why did the government rule that? Because we were in such a low interest rate environment for so long, there was some pressure because the investments we have that back the policies that we issue, that provide security for our clients, our investments weren't performing that well. We're at the lowest interest rate possible. Just in the 18 years I've been with Mutual Trust, it's astonishing where we've come. So our investments are fixed, they're safe, they're not at risk. We get high ratings, us and every other insurance company. We all play by the same rules. We're a safe place to be. How do we feel about this? Some comments. And I posted in the chat, through every recession, through every depression, whole life companies have met the needs of our clients. We've never called the bank holiday. We've been there throughout because we are safe, because we are secure, and because we're there for our clients. It's who we are supposed to be. I look at those charts and I look at what Scott's speculating. Are we going to go down 42%? I sure as heck hope not. I don't want to take 5.78 years to get back, but here's what I know. My two whole life policies that I own myself, bring it on. Let's bring on inflation. Let's bring on prime rate at 18.5%. Well, I don't really mean it, but if that happens, guess what? Our investments are going to prove to be a lot better. And what that means for you as a policyholder, your profits are going to get a whole lot better. So Scott showing you some conservative growth numbers based on the guaranteed rate. It's going to do better than that when you get a share of profits. There's a downturn in the market this year. I'm not worried about it. That slow and steady is always going to win the race. And if you're a client or you're an individual who likes to speculate, fine, go ahead. But the first thing of your financial portfolio better be something that's safe and secure. It's what you learned in Economics 101. Create your foundation first. Whole life is it. It's not going to vary through anything that we're going through right now. And what I know is I've got cash that's sitting on the sideline right now, ready for me to use it if and when I use it.
Yeah, sorry, I just have one more follow-up. I know there's questions in the chat box there, Mark. What is the insurance carrier's position on me borrowing my money out of my whole life and putting it in the market?
Did I ask you why you wanted your money?
So to the joke that went on yesterday on the call, I can have my cake and eat it too.
Yeah, absolutely. I'll call it 10, 12 years ago. I'm old, so I forget how far back things happen. I was at the Nelson Nash Infinite Bank think tank, and I did a case study with an agent of ours. And he's like, I got an investor. The guy doesn't believe in anything safe. And I said, oh, no, you're wrong. I'm like, I bet you he has money in a safe place. And he said, all he cares about is ROR. What's my rate of return? I want the most bang for my buck. I said, okay, ask him one question. Where does he keep his opportunity money? You know what opportunity money is? That's sitting somewhere that when you see an opportunity to go make a big number, you grab it, go invest it. It makes your big number, you cash out and you put it back and you wait for that next opportunity. Where do you think that client had his money? Just sitting in a bank. Or it was sitting in a safe. Guess what it was earning there? Nothing.
What?
Guess what it did for him? Nothing but be money sitting on the sideline. We got him to create a very healthy, beautiful whole life policy where that was where he stored his money. And guess what it was doing? It was growing at a very nice little percentage, better than what it was doing before. Guess what else it did? Provided an incredible death benefit for his family. So if something happened to him, he was good.
Hey, Mark, what's 3% divided by 0?
That'd be 0.
I think that's an infinite number, right?
Oh, I'm sorry, infinite. Yes.
Yeah. So that's the difference. It's infinitely different.
Infinitely different.
Just a reminder, I think this year, 2022, there are more people that are going to be cashing out 401ks, rolling them into IRAs than at any other time in history because of the baby boomer thing. And what a tragedy if they put that money in the wrong thing. So they're already going to be taxed at a humongous tax rate. Speaking from experience, don't worry about it. You'll be not earning less money whenever you retire. So what? Money is still money. I mean, it costs more for a loaf of bread today than it did 50 years ago. So, these people don't know what they don't know. And they really are looking for help, and they're getting that help from the wrong people. So Jonathan asked a question about a variable annuity. I have a 65-year-old woman who is talking to a financial planner. She hasn't paid her anything yet, who is advising her to overfund her 401k. So she gets a little bitty tax break on the seed. And if that money grows, she's going to be paying taxes at a higher rate on the harvest. So
thank you for beating that drum, Lorraine, about what not to do.
yeah, well,
Right.
yeah.
Appreciate that.
Well, I just asked questions. So
Okay.
I I didn't tell her what to do.
Okay, we got, we're getting close to the end here. Anybody else have any questions? Obviously, if you're veiled, then you're not interested in asking any questions. What time is it in Hawaii right now, Heather?
It is 1:47.
Okay. All right, folks. Well, I don't see any questions in the chat and nobody else here. So thank you, everybody. Thank you again, Mark Creighton. I really appreciate you being here, for being a partner with us here at Symmetry and Quility, and your team and your staff are fantastic to work with. Marty, you're unmuted. Do you have a question?
No, I just want to say thank you, Scott, for everything you do for us,
Well,
and
guys.
appreciate all the input and advice from everyone here.
All right. Well, look, everybody, it's that time. Go out, help some families. I'm gonna go eat some dinner. Have a good night. See you next time.
Sounds good. Thank you.
Bye, everybody.